Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, October 18th, 2024. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, will China's stimulus efforts disappoint investors? Will China's stimulus efforts disappoint economists? And will the BOJ add to global bond market volatility? Our answers are China's latest activity and property market data were supportive of our here comes the liquidity theme, while more promises from the PBOC fall short of the helicopter money to Chinese consumers that many Wall Street economists are calling for. We do not think it is prudent to fight the market here. 42 Macro's institutional clients collectively manage trillions in AUM, and not one of them has a balance sheet big enough to take the other side of the PBOC's trades. We still maintain our structural view that China is headed for a balance sheet recession thanks to a toxic combination of private sector over-indebtedness, capital misallocation, and a shrinking labor force. The fundamental reason why Dr. Mo has had 42 Macro clients max long China since September 17th is because Chinese authorities now fear the same outcome and are implementing monetary and fiscal stimulus to combat it. FYI, FXI is up 22% since then. Their efforts won't work other than to promote a transitory bounce in Chinese growth. Japan's September CPI data were also supportive of our here comes the liquidity theme. The current Goldilocks market regime is likely to culminate with significantly higher prices for risk assets to the extent it persists over the medium term. Per our fundamental research summary, we have plenty of data-driven reasons to think it will. Transitioning to our 42 Macro dashboard here, as always, we'll wrap up with our question from our community. This one's regarding our weather model. It says, hi, Darius. First of all, I want to congratulate you and Team 42 for the diversity and quality of data that you provide, supporting amazing conclusions and actionable ideas with real results. That's really great feedback, so I appreciate that. So thank you for the kind feedback, my friend. The question goes on to read, I was wondering if the weather models were used only for us to be mentally prepared for a certain environment change in a particular asset class to happen in the near-term future, or if it had to be integrated somewhere in the actual current positioning of a portfolio in anticipation for that change to happen. Similar question for the grid model used for assessing probabilities of regime changes versus the global macro risk matrix derived from the VAMs, actually using that to position for the portfolio itself. So yeah, thanks for your great work and for your time. So excellent question. You know, one of the things that we do here at 42 Macro that I've observed many of the best institutional asset managers doing around the world is they separate their research from the risk management. And what that effectively means is the process by which they use to decide what they like and what they don't like is different from the process that they use to decide when to be long and short those things and how much to be long and short. You know, separating those two factors sort of allows you, it sort of forces the removal of emotions and overreactive and hyper trading from the institutional portfolio. And that's generally why institutional investors compound returns at higher rates and certainly at higher risk adjusted rates than the average investor. So that was one of those sort of, you know, just structural, you know, kind of process oriented things that I think investors can implement into their portfolios or into their investment strategy that we implement into our investment strategy 42 Macro that obviously thousands of investors are mimicking around the world. That's something in our opinion adds a lot of value to portfolios from the perspective of compounding returns and avoiding drawdowns. So getting back into the question specifically, do we use our macro weather model, which again is designed to project the excess returns in the various asset classes, the 5 liquid asset classes on a rolling 3-month forward basis, and our grid model, which is designed to project where growth and inflation are headed and how that's likely to coalesce in macro regime terms over the medium term. We don't use either of those models to influence what clients experience in their portfolios. The only 2 signals that we generate for our clients here at 42 Macro that impact their portfolios are either our KISS portfolio construction process, which is a systematic trend following approach, or discretionary risk management overlay, which is also a systematic trend following approach, but it's more designed to help institutional investors stay on the right side of factor along short risk in asset markets. And so either of those 2 systems are completely systematic that are born out of our market regime nowcasting process, dictating what types of exposures investors should experience in their portfolio from an asset allocation or portfolio construction term. And so everything else we do, everything else I say, every other piece of research that we pump out, including our macro weather model, our grid model, our fundamental research themes, you know, everything we talk about with respect to growth, inflation, policy, liquidity, that's all to help investors proactively prepare for a market regime change so that when regime change comes, they feel confident in making the appropriate pivots in their portfolio to stay on the right side of market risk, right? You have a choice. You don't have to stay on the right side of market risk. Let's just say we go into a big bear market and you max long a bunch of stuff. You don't have to sell anything. You can just ride the whole bear market down and lose a bunch of money. However, if you want to stay on the right side of market risk, you obviously need to book gains heading into a bear market or very early in a bear market with the intention of obviously getting back invested, shortly at or near the lows, which is exactly what both KISS and Dr. Mo do for our clients in spades. And so very proud of those tools, really proud of our audience that's growing. I'm watching the quality of the questions continues to improve. Not only the quality of questions, but the quality of responses to each other's questions continues to improve. I can tell that we are really, truly educating investors around the world at an institutional level here at 42 Macro. And that's something me and our team are very proud about. So we'll wrap it up there. Darius Dale presenting our Macro Minute for Friday, October 18th, 2024. Everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.